The discipline to maintain discipline. The message from David Kelly at JPMorgan Asset Management, the chief global strategist. He joins us now. David, build on that. What do you mean by that?
Well, I think that we're in a recovery, but this recovery is about to slow down. I mean, the sound that you hear outside is screeching brakes because this V-shaped recovery is going to slow a lot in the fourth quarter and into early next year. And I think it's important not to just to pile into momentum stocks. We've seen the stock market do wonderfully well this year, but there are parts of the stock market which have frankly done too well, given the amount of uncertainty out there and given the fact that down the road we are looking at higher taxes and higher interest rates. So I think it's very important for investors at this stage to be disciplined, realize that just because we've seen some good economic numbers, because the market has seemed to be okay here, don't take your eye off the ball. Recognize that we've still got a long way to go before this pandemic is really over.
Within it is the idea of what the return will be. All the actual assumptions, David Kelly, has been we're supposed to invest for single-digit return. Yeah. Nobody believes it that's on these high flyers. Do we go back to a single-digit world?
We have to eventually, because in the end, it's about nominal GDP growth. And what's happened for a long time, actually for decades now, is we've seen the value of financial assets in the U.S. rise much faster than overall nominal GDP. But ultimately, it's about the growth in goods and services produced by the U.S. economy. And so there is going to be some correction along the way here. And we are going to see a return to single-digit returns. And so it's very important for people, look at valuations carefully, because the things that are most overvalued are the things that are going to get hurt the worst when there is a more significant correction.
Well, David, when you talk about how we could see a correction in what? In tech stocks? Because right now we're seeing an ongoing performance, at least for today, a return to the underperformance in small caps, in financials, and tech is what's recovering.
Well, yeah, and because this market is very momentum driven. I mean, I think this year has been so difficult for fundamental analytics. I mean, how do you figure out what these companies are really worth and the sort of world we're looking at post-pandemic? So I think investors are just jumping into the momentum trade here. But when we get through this, when we have a more normal economy, as that begins to shape out, and we have a sense of it in 2021 and 2022, I do think that value stocks should do better than growth. Growth is very expensive relative to value. It's the most expensive it's been since the tech bubble. I also think that international ought to do better than the U.S. A very similar story. Both EM and developed country international are cheap relative to the U.S. So I think you need to think about the boring middle of the market here and try not to be too enticed or enamored of high-tech, large cap, mega cap growth stocks.
Oh, David, fold your economics in here. Kasman and Feroli, your economists, make very clear they have a very cautious view out. Is that cautious view folded into fourth quarter, or is that a cautious view for next year?
It should be in the fourth quarter if we're looking at quarterly GDP. We saw GDP fall by 32% in the second quarter. We think it could rise by as much as 30% in the third annualized, but then only rise by about 3% annualized in the fourth. So there's a very sharp deceleration in growth. And you're going to see that in jobs. I mean, if you look sequentially, okay, we added 1.4 million jobs last month. That's good. But we think that job growth will now decelerate to about less than 1 million per month, which sounds okay, except we're still 11 million jobs short of where we were in February. So again, a deceleration there. So I think in the monthly numbers, it's upon us. In the quarterly numbers, we're going to have to wait for the fourth quarter to see that deceleration.
What's the run rate on nominal GDP that you then fold into your forecasting of the equity markets?
Well, it's hard to talk about a run rate in either 2020 or 2021.
Agreed.
When you get, but once you get into 2022, we're looking at something in the order of 4 to 5% once we get back to close to full employment. But you're going to be, we'll have to bring that unemployment rate down for a while here. But we've got another problem, which is that we've got a demographic crash going on right now, which is also going to take something out of GDP growth when this pandemic is over.